Welcome to Singapore Property Talk Law. We've got some really interesting articles here about City Developments Limited, CDL. Looks like quite a bit happening, especially behind closed doors.
That's right. Boardroom dynamics, potential ownership shifts. It's got all the ingredients.
So our mission today is to, cut through the jargon and figure out the key takeaways for everyone listening.
Exactly. Well, look at this share buyback plan, what it means for the Kwek family's stake, and how it all ties into that public disagreement between Kwek Leng Beng and his son, Sherman.
Plus compensation, governance stuff.
Yeah,
Yeah, lots to unpack. You want a quick insights? We'll deliver.
let's do it.
Okay, so first up, the share buyback proposal. CDL is going to its AGM April 23rd, asking for approval to buy back its own shares. What's the gist?
Uh-huh. They want permission, basically, to renew a mandate. It lets them buy up to 10% of their ordinary shares and also 10% of their preference shares.
Right, so it's not a new thing they're asking for, more like keeping the option open.
Precisely. Keeping the option on the table.
And why do companies generally do this? What's the reasoning CDL gave?
Well, they mentioned a few things. It can potentially boost earnings per share, net asset value per share, basically making each leftover share worth a bit more on paper.
Okay.
It's also, an alternative way to return cash to shareholders, maybe instead of dividends, and it gives them more control over their capital structure.
And maybe signals confidence too, like, we think our shares are cheap.
Yeah, that can be part of it. Bolstering shareholder confidence, as they put it. They plan to use internal cash or maybe borrow funds for this.
Okay, makes sense. Now, the big point seems to be how this affects the Kwek family's control.
Exactly. This is crucial. If CDL actually buys back the maximum allowed under this mandate,
Yeah.
the Kwek family's controlling stake, which was just under 50%, around 49.29% in March, well, it could jump to over 55%.
Wow, okay, from under 50 to over 55. That's a significant jump.
It really is. Crosses that important 50% threshold.
So what does crossing 50% mean in practical terms, especially thinking about takeovers?
Right. So in Singapore, the rules are quite clear. If you buy 30% or more, or if you're between 30 and 50 and buy another 1% quickly, you usually have to make an offer for the whole company.
A mandatory offer, right?
Yep. And if you already hold over 50%, different rules apply, usually needing a voluntary offer if you want to increase it further under certain conditions. But the key thing here is that the Securities Industry Council, the SIC, has basically said that this specific buyback, if it pushes the QX over 50%, won't trigger a mandatory takeover offer from their investment vehicle, HLIH.
Ah, okay, so they get to solidify control above 50% without having to make a general offer.
Exactly. It's seen as a consequence of the company buying its own shares back, not the family actively buying more in the market in the usual sense that triggers the rule.
So this could be a way to fend off unwanted attention, maybe, especially after all the recent boardroom stuff.
That's certainly one interpretation, strengthening the defenses, you could say.
And what about the preference shares they might buy back? Do those affect control?
Not really in the same way. Preference shares typically don't have general voting rights, so buying those back doesn't impact the takeover code implications related to voting control.
Got it. One side effect, though. Less shares available for the public to trade. The public float decreases.
Yeah, that's right. It could drop from just over 50% down to around 45%.
Does that matter much?
Well, a smaller float can sometimes mean lower liquidity, maybe harder to buy or sell large blocks without moving the price. Something for investors to note.
Okay. Let's pivot to that boardroom tussle. It got quite public, didn't it?
Oh, absolutely. The disagreement between Kwek Leng Beng, the chairman, and Sherman Kwek, his son and the CEO,
Yeah.
it definitely made headlines. And it seemed to hit the share price, too.
What was the core issue, reportedly?
Reports pointed towards disagreements over an advisor, Catherine Wu, specifically her role at the hotel subsidiary, M&C.
Millennium and Copthorne, yeah?
And there were also accusations, apparently from Mr. Kwek Leng Beng, about his son orchestrating a coup regarding new independent director appointments.
A coup. Strong words. What was unusual about those appointments?
Well, the company's own annual report notes that 2 new directors appointed back in February came on board without the usual process of prior review and recommendation by the nominating committee.
And wasn't Kwek Leng Beng involved with that committee?
He was initially, but then he was apparently excluded when a new committee was formed later, so definitely not standard procedure.
Sounds like some serious internal friction. Did the regulators get involved?
Yes. SGX Redco, the stock exchange's regulatory arm, reportedly questioned CDL about the corporate governance issues surrounding all this.
How did CDL explain skipping the usual process in their report?
They acknowledged the deviation but defended it. They said it was necessary and appropriate because of underlying governance concerns they had, specifically related to that advisor, Catherine Wu, at the hotel subsidiary.
So it all circles back to her role. Who is Catherine Wu? What's her background with CDL and the family?
She seems to have had a long working relationship with Mr. Kwek Leng Beng. She was a director at M&C, then her services were terminated in early 2024, but she was brought back as an unpaid advisor just 7 months later.
Interesting. And she's now left that advisory role.
Yes, she resigned from the unpaid advisory position in March 2025. So a bit of a revolving door there, it seems.
Definitely adds layers to the story.
Yeah.
Okay, let's look at pay. Both father and son saw their compensation drop in 2024.
That's right. Mr. Kwek Leng Beng's total pay was about $5.97 million, down from nearly $7 million the year before.
Okay.
And Sherman Kwek's was $2.97 million, down from $3.52 million. And apparently, he voluntarily skipped his long-term incentive grant, which was worth over $1 million.
And this lines up with CDL's performance, right? Profits and revenue were down.
Exactly. Net profit took a noticeable dip in 2024, down to around $201 million from $317 million. Revenue also fell quite a bit, so the lower pay reflects the weaker financial results.
It's a whole CDL situation. It feels like a case study for family businesses, doesn't it?
It really does. It highlights potential weak spots, blurred lines, maybe succession planning issues, governance structures that haven't kept pace.
What do governance experts usually say about situations like this? Keep things separate.
Pretty much. Clear boundaries between family interests and company interests, strong independent oversight, and really robust governance principles that hold up even when things get tense.
And succession planning needs to be, what, more formal, less about just family ties.
Ideally, yes. More about merit, maybe using objective third parties to help avoid unconscious bias. It should be a clear process.
It's quite something that a big, successful, multi-generational business like CDL ends up airing this stuff so publicly.
It shows how quickly things can unravel, or at least look like they're unraveling to investors, when there's misalignment on authority, oversight, and just basic expectations at the very top. Investor confidence is sensitive to this stuff.
And the share price reflects that sensitivity, right? You mentioned it hit a low.
A 16-year low, actually. Hit $4.48 on April 8th. The stock's down quite a bit this year, maybe 12% through Monday's close, and it's fallen significantly overall since Sherman Kwek took over as CEO in 2018.
And the timing of the recent drop coincided with the bad results and the public feud.
Yeah, the weaker 2024 results came out, and then bam, the family feud news broke in late February. It was kind of a double whammy for the stock.
So looking ahead to the AGM on April 23rd, what should shareholders be watching?
Governance, governance, governance. That's got to be top of mind. Scrutinizing the whole director appointment process, the reasons given.
And directors are up for re-election too.
Yep. The two new directors appointed under unusual circumstances, Jennifer DeWong-Young and Wang Suyen, plus 3 other independent directors, are all up for re-election.
So that could be a real focal point for shareholders to express their views.
Absolutely. Could be some pointed questions asked.
Okay, so pulling it all together, this share buyback isn't just some dry financial move. It's happening right in the middle of this major boardroom drama and questions about control.
Definitely. The potential increase in the Kwek family stake via the buyback looks like it could be a strategic move to create stability, maybe lock things down after the conflict.
But the whole episode really throws a spotlight on the challenges, even for a giant like CDL, when family dynamics and corporate governance clash.
And the share price reaction just hammers home how much the market dislikes uncertainty and perceived governance risks.
So it leaves us with a question, really. How do you balance the idea of strong family control, which can sometimes be good for long-term vision, against the risks we've seen play out here?
It's a classic dilemma in family-controlled businesses, a really fascinating situation unfolding in Singapore's property world.
Well, hopefully this Singapore property talk law deep dive has helped clarify what's going on at CDL. Certainly one to keep watching as the AGM gets closer.
For sure. These things often have more twists.